Welcome to the lecture on Introduction to Stocks. So, we are mostly conversant with the term these stocks or bonds, which are basically used by the financial companies, investors use these stocks and bonds. So, in this lecture we are going to have the introduction about the stocks, how these stocks are evaluated, how these stocks are valuated. So, how valuation of stock is done, and then what are the terminologies which are into picture when we deal with these buying or selling of these stocks. So, these are the facts which we are going to discuss in this lecture. Now, as we know that the business firms, especially for the large corporations where you require quite a large fund for infrastructure or other amenities. So, they take additional external approach, that is other than the maintaining solid equity by retaining their earnings to finance their capital needs. And for funding their startup operations, they maintain the continuous spending, and for maintaining their continuous spending and fund their expansion projects, these corporations they raise these needed capital by issuing and selling stocks and bonds. So, these are the one they basically issue, sell, and then they generate these capital from the public. People try to invest their money by purchasing these stocks, and these companies sell their stocks, and then they are benefited also in the long run, because depending upon the conditions under which these are purchased, kind of stocks which are purchased. For corporations, these stocks are major external source of equity capital that have claims on a firm's income and assets secondary to claims by their regular business creditors. So, they have certainly once you have the stocks, once you purchase the stocks, then certainly you have the claim on the firm's income. Now, when we talk about these stocks, you have two types of stocks, that is common stock and the preferred stock. Common stock are the most basic form of business ownership. They place a minimum constraint on the firm. So, you have basically two types of, as we discussed, common and preferred, and that will be the most basic, and they are basically compensated with higher dividends, and they also enjoy the voting rights, because at the management level you have to many a times the decisions are taken. So, they have say there and they have the voting rights. So, as compared to the holders of the preferred stock. So, common stock also can be owned privately or publicly. Then about the preferred stock, it is told that these are of the fixed income type, and stockholders receive as a dividend the fixed percentage of amounts or amount of firm's earnings. So, they are first paid, and they are paid as a fixed percentage of the amounts of the firm's income, and certainly they are, as the name indicates, they are preferred over these common stockholders, and the firm is really obligated. So, that is why they are preferred, because the firm is obligated first to pay these dividends to the preferred stockholders, and then it has to go to the common stockholders. Now, when you have when we deal with, so people, what we people do is that people have to purchase this stock and they have to get the benefits. So, they get benefit time by time. So, the stockholders can earn money not only by receiving dividends, but by also trading and making capital gains through buying and selling the right stock at right time. Basically, the stocks which is being purchased by any person. Now, he has the freedom, either he can get continuously the dividends, or as the time progresses, depending upon the value of that, if he has purchased the stock at lower price, and if the value of that stock is increased, in that case he can sell it at a larger rate. So, he can earn capital, he can have capital gain by selling those stocks. So, basically that way you have the definition of undervalued and the overvalued stocks. So, as we know that undervalued means whatever it should have the value, it is lesser than, its value is less than that. So, undervalued stock means the true value of stock is expected to be higher than its market value, and overvalued stocks means that true value of stock is considered to be less than what it is sold for in the market. Now, it is also affected by investor has to be aware about when you are selling or you are buying, then you have the because there will be price fluctuations as the time progresses. There may be up in the value of the stock, or there may be downfall in the value of the stock, and also while buying or selling you will have to pay the brokerage fees and the commissions, and there are ways to calculate these brokerage fees, and these are basically set on the market value of the stock and also the number of shares which are purchased or sold. So, these brokerage, how much brokerage you have to pay, or the commission how much you have to pay, it will be depending upon the the market value of the stock and also how many stocks you are purchasing or selling. And normally it is a this brokerage which is calculated, it will be a combination of the fixed part and the variable part. So, there will be fixed cost calculation and plus. So, the variable means how many shares you are selling. So, based on that there will be variable cost also. So, that way they are calculated. For example, suppose you want to see the example that for a now first of all, whenever we deal with these finding these value of the stock, or finding the cost of the share which is sold, what is the capital gain or capital loss. So, you will have a table which will tell you that what will be the brokerage fees. So, let us you can understand by looking at the example where we will be calculating these values. Suppose a company is there and it has purchased 350 shares. So, a company purchased 350 shares, and it has purchased at the rate of 25.75 rupees per share. Suppose this company has purchased 350 shares at this price, and then but later sold 200 of its shares, it has sold, and it has sold at 29.25 rupees each. So, you have to find the capital gain or capital loss in these transactions, and also the investment rate of return in such cases. Now, in these cases you have to know that what is the brokerage fee which is there while transacting these shares or these stocks or shares. So, that will be basically denoted by table, and the table tells that if you have amount of purchase or sale, so it will be depending upon that, and on that basically you will have a brokerage charge. So, brokerage charge, as we indicated, there will be fixed charge that will be rupees, and then you will have the percentage. So, both added that will tell you the whole brokerage charges. So, maybe on 2500 it is something like 25 rupees plus 0.015. Similarly, on 2501 to 6000, you gave something like 50, and here you give 0.007, and then from 6001 to 22,000 you are giving 70 and 0.006, something like that, and maybe from 22,001 to 50,000 you are giving 90 and 0.004. Let us say you may have another rule. Now, if these rules are there, in that case how then what will be the capital gain or loss of the company, or gain will be what, and also the rate of return, what will be that investment rate of return. So, how you will calculate all these things. So, let us see that what will be your total cost of investment. So, first of all you will find the total cost of investment. So, while finding the total cost of investment, we know that you have purchased 350 shares at 25.75 rupees per share. So, your initial investment is 350 shares multiplied by 25.75 per share. So, it will be around 9012.50 rupees. So, this is your initial share. Now, in this basically you have to see that what is your brokerage charges. Now, in this case this is 6001 here, not 60,001. So, you see that this 9012 will be coming in this bracket. So, you will have the brokerage charges, and the brokerage charge will be 0.006% of this amount and plus 70 rupees. So, brokerage percentage. So, total brokerage charge. So, total brokerage fee. Now, that will be rupees 70 plus this is 0.006 and multiplied by this is 9012.50. So, it will be basically it is 1.5% or 7%. So, it is 0.006 means 0.6%. So, you cannot say this is percentage, it will be 0.15%. So, this is basically the factor by which it should be multiplied. So, if you calculate that, it will be 124.08. So, it is not basically percentage, you can say percentage will be 1.5. So, that is how you should take it like this. So, this will be your brokerage fees. So, cost of total investment, if you look at, it will be your initial investment price, that is 9012.50 plus 124.08, and that will be your 9136.58. So, this is the cost of investment. Now, you have to sell this your stock, so or share. So, now you are selling it. So, now further net sale if you calculate. Now, selling you are doing for 200 shares, and 200 share is being sold at 29.25 rupees per share. So, total sale will be 200 into 29.25. So, it will be 5850, and if you look at the brokerage on the percentage sale, this brokerage on percentage sale will be 50 plus 0.007 times 5850. So, total brokerage will be 50 plus, and this is 0.7%. So, 0.007 multiplied by 5850. So, if this is multiplied, you will be getting like 90.95 rupees. So, you are now in this case, when you have found the total cost of investment, you have to add the brokerage fee to the initial investment, whereas when you are selling, you have to subtract this amount. So, net sale will be 5850 minus 90.95. So, it will be 5759.05. So, this is your cost of 200 shares, this is the cost of 200 shares. Now, what we have to calculate is that since we are doing for 200 only, so we have to find the cost of 200 shares based on this value which we have got. So, if you try to find the cost of 200 shares, in that case this amount 9136, this will be multiplied by 200 by 350. So, that will tell us the cost of 200 shares sold. So, cost of 200 shares basically which sold. So, you have 9136 into 200 by 350. So, that will be your 5220 and 0.85. Now, what you see that this is the cost of the 200 shares which were sold earlier, and you have sold, and net sale is coming as 5759.05. So, capital gain will be whatever you have sold. So, capital gain will be something like 5759 and 0.05 minus 5220.85. So, this will come out as 538.19. This is the capital gain while you are selling, because we have to calculate only for 200 shares. Earlier we got the cost of the shares for total cost of investment as for 350 shares. So, this is your capital gain, and that is why the rate of return, if you have to find, you are getting the rate of return will be on 538.19, and this we are getting for the 5220.85, and that will be multiplied by 100. So, that will talk about percentage. So, it will be 10.3%. So, it will be 0.103. So, that will be 10.3%. So, this is how you calculate these cost, rate of return and the capital gains when we are buying or selling the stocks, and we try to find the what is the income on the net gain or capital gain on that, and based on that we find the rate of return. Now, we will talk about the stock valuation, how to value how to see what is the value of the stock, because you are purchasing and you are getting a certain amount every year. You may get a fixed amount every year, or the amount which you are getting as dividend on that stock, that may be changing, that may increase every year by certain amount. So, basically ultimately you need to find how to find these what is the rate, expected rate which you are getting, or I mean rate of return which the that is investor is expecting to receive, that is known as the market capitalization rate, MCR, or also we call it as rate of return, because everybody is looking for that rate of return. So, so in this case basically we will see that how these valuation of these common stock is done. So, what is happening that there are two terms. So, when we talk about the valuation of common stock, in that case we are concerned basically to find few parameters, and we call it as, suppose the investor basically it will be purchasing a certain stock on a price. So P naught, and then he will be trying, so he will be purchasing that on P naught and he will be getting dividend D. So dividend, he will be getting dividend D every year. So he may be getting this dividend as long as he is keeping that. So that will be, that as long as he will be having that, because there is no maturity date for this, it will be going on as long as he is having that stock with him. Now in this case there will be certain rate of return that is defined, and that is what this market capitalization rate is all about. So it will talk about how he is getting what he is getting when he is going, suppose he is going to sell that at some point of time. So it has certain value at that moment of time. So P0 that will be having, so once he sells that in the next year, he will be selling at certain price, and in between he will be getting these dividends, and he may be selling at a higher price. So he will be getting certain returns, and that will be known as the market capitalization rate or the rate of return. Now we have to see that see, this is defined. So this is market capitalization rate, or this is the expected rate also. It is also known as the expected rate, that is your ER. So this is basically or the rate of return. So this basically is defined as the dividend, and then you have the PA. So that is your appreciation in the, so that is your stock price appreciation. So that is the difference between the current purchase price and the expected price P1. So that will be your price appreciation, and divided by then P naught. So PA will be the price appreciation, and this will be P1 and P naught. So P naught will be the current price, and then P1 is the appreciated price of the stock. So once you know that, and with respect to P naught, you will be getting the value, that is rate of return. So what on what rate of return his stock is can be evaluated as. So you can calculate this rate of return as as we discussed, that it will be D plus PA by P naught, and PA is nothing but P1 minus P naught by P naught. So this is how P naught is the current purchase price, and P1 is basically the expected price. So after 1 year. After 1 year purchase, 1 year, after 1 year of purchase. So what we see that in this case you can have the value of the rate of return. So you can say that suppose for example someone has purchased, suppose a person purchased a certain, say 50 shares, a person purchased 50 shares of stock in a local firm, and at the rate of 75 rupees per share. Now he will be expecting, he expects to get dividend. So he expects to get dividend of rupees 4 per share, and also selling. So this will be selling, he will be getting at the end of year, and then he will be selling, and he will be selling. So expecting, so he is not be selling, because it is only his expectation that he will be selling at 80 each. So what you see that he has purchased at 75, and then getting dividend also of rupees 4, and then selling at 80. So in that case, what will be the expected rate of return. So, R will be what? So, you can find R will be D plus P 1 minus P naught divided by P naught. So, we know that the dividend he is getting 4 and value is 80 and then he is getting 75 and divided by 75. So, he will be getting 9 by 75 basically, and that will be 12%. So, 12% is the rate of return in that case. Now, we can use different type of formulas because what happens that its rate will be changing every year. Now, we have calculated that the P naught if you calculate, P naught will be D 1 plus P 1 divided by 1 plus R. So, basically what you see is that D 1 plus P 1 by P naught will minus 1 will be R. So, from here you get this expression as P naught will be D 1 by plus P 1 by P 1 plus R. Similarly, P 1 will be D 2 plus P 2 divided by 1 plus R. So, when the R is the market capitalization rate. So, P 1 will be defined as D 2 plus P 2 divided by 1 plus R. Now, we can put the value of P 1 into the P naught formula. So, if you put this formula into that, so let us start fresh. We calculated we found that P naught is defined as D 1 plus P 1 divided by 1 plus R, and D P 1 will be D 2 plus P 2 divided by 1 plus R. So, if you find P naught you get this P 1 value from here. So, it will be D 1 by 1 plus R plus P 1 by 1 plus R. So, it will be D 2 plus P 2 and by 1 plus R square. Basically, it will be same because it will be D 1 by 1 plus R plus P 1 by 1 plus R, and P 1 is this much. So, it will be D 2 plus P 2 by 1 plus R raised to the power 2. So, similarly, you can go for the. So, this is also can be written as D 1 by 1 plus R and then plus D 2 plus P 2 by 1 plus R raised to the power 2 plus D 3 plus P 3 divided by 1 plus R raised to the power 3. So, this will continue to go, and if you write in general, if you have suppose you talk about something like in future for k years. So, in that case we can write P naught as D 1 by 1 plus R plus D 2 by 1 plus R raised to the power 2, something like, and it will go up to D k plus P k divided by 1 plus R raised to the power k. So, if you try to summarize, and if you try to write in a standard manner, you can write P naught or P 0 as summation of t equal to 1 to k, and then you can write D 1 by 1 plus R, and that will be raised to the power t, and then you will have finally you have plus P k upon 1 plus R raised to the power k, because in the up to this d k by 1 plus R raised to the power k will be encompassed in this term, and then ultimately your term which is remaining will be P k by 1 plus R raised to the power k. So, that is how you can find these present value of the stock, and this formula can be used. So, what you see that in this case you can see that the present value of this current price of the stock, it is interpreted in these terms, and they talk about the sum of these discounted dividends for the number of their future years. So, this is the discounted dividend, because you are getting its value is nothing but you are getting its corresponding value at the present time. So, it is this is discounted value of these future dividends and for the number of future years. Now, if that year is approaching towards infinity, in that case if the k is approaching towards infinity, then this term will be vanishing, that will be 0. So, in that case you can write, so you will be writing when this k will be approaching towards infinity. So, you can write that P naught will be summation of t equal to 1 to infinity, and then there will be only dt by 1 plus r raised to the power t. So, this is how, now in these cases you have, this is your dt, this is changing basically d1, d2 and d3. So, you will have this term coming up, and you can find these values like that. Now, if the d remains the same, if the dividend remains the same, in that case this d can come out. So, if dividend remains the same, so you can say that this P naught will be, now from here you will get summation, and you will have t equal to 1 to infinity, and here your d1 will come. D1 is the fixed dividend which you are expecting to get, and then it will be 1 by 1 plus r raised to the power t. And if you look at this sum, so it will be nothing but 1 by 1 plus r minus r. So, being a geometric series, so it will be d1 by r. So, P naught will be d1 by r in case of when this t approaches towards, the k approaches towards infinity, you have P naught as the d1 by r. So, that is how you calculate these present price of the stocks you are calculating. You can also use another formulas which we have discussed, that if there is a growth in the dividend by certain factor, then you have the 1 plus g factor coming into picture, and in that case you will have P equal to d1 into 1 plus g by 1 plus r, then plus d2 into 1 plus g to the power 2 by 1 plus r raised to the power 2. So, that way it will move, and then if it goes towards if you find its sum, then it will be P naught will be, or P0 will be d1 divided by r minus g. So, that type of formula also you can get in such cases, and you can find these formula, that is current price of these stock, that when we calculated using these formulas. So, this is the concept about these stock valuation when we talk about these common stocks, and we will talk about more aspects of the stocks and also about the preferred stocks in our coming lectures. Thank you very much.